Hello, welcome to this week's Market Carver. I'm Andrew Thrasher, Portfolio Manager for Financial Enhancement Group, joined by Zach Unger, Senior Analyst for Financial Enhancement Group. We've got two topics to look at. We're going to look at the Fed and the changes that they're having in rate policy and the expectations for rate cuts in December, as well as some really interesting developments to how they're coming to these rate decisions. And then Zach's going to look at a topic that I feel like we've been talking about a lot this year, as the significance of spending going on by the mega cap tech companies and what that's kind of ballooning or bubbling into today. But first, we're going to talk about the rate cuts. So something that's been going on since it started in Trump's first administration. We're seeing in his second administration really having a lot of talk to the Fed. Trump's made it no question that he's not been satisfied or happy with how the Fed has handled interest rates, really trying to push and call for rates to come down. And this is coming at a time where historically the Fed is supposed to be independent. It's not supposed to be a political entity. You'll notice when you go to the voting box, you're not picking a Fed chair. It's supposed to be kind of this independent, neutral entity. Of course, that's never 100% fully true. But what's interesting is we start seeing the White House become more vocal to what they believe Fed policy should have. In fact, even calling for the fact that the White House should be involved in setting interest rate policy. We're starting to actually see the move the other direction of actually more independence within the policymakers. So when the Fed meets, they have the governors, they each vote, and typically we see a lot of consensus towards how the Fed governors will vote on whether to raise, cut, or keep constant the interest rates. We're starting to see that change now. We now have 4 voting members who clearly want to keep rates keep them steady. And that means 3 or 4 undecideds need to vote to keep the cuts moving. And so this is a big breakaway from history. Normally, the Fed chair is basically able to read the room, get consensus. Everyone's on the same boat, so to speak, to what rates should be doing next. So this chart that we're showing you on the screen now is showing the probability of a Fed cut in December. As that line moves higher, actually shifts the less likelihood of a rate cut. We went from basically back in September, October of the market having 100% expectation of the Fed cutting rates in December to now it's basically a coin flip at almost 50%. This is, again, very unusual. Normally, the market is a little bit more in tune with what's going on or the expectations by the Fed. But the fact that we're seeing more governors break away and starting to be a little bit more independent is causing that consensus to break down, and we have a little bit less read-through to what the Fed will do in December. It also is getting a wrench thrown in by the fact that we don't get all the data during the government shutdown. Expectations, we might not get the last jobs report from October. We're continuing to get the rest of the data slowly released. And so the Fed doesn't have full visibility on the economy as well to make those rate cut or rate hike type decisions. So it's going to be really interesting as we get into December and what the Fed will do. Start looking at some of the speeches that the governors start giving and try to parse through the data to see where interest rates may or may not be moving into the end of the year. Now I'm going to turn it over to Zach, who's going to bring it a little bit more market focused, looking at some tech spending by the behemoths of our stock market.
Yeah, as Andrew mentioned, we have talked quite a bit recently about concentration in the equity market, particularly the Mag 7 names, the NVIDIAs, Amazons, Apples, etc. The large percentage that their market cap makes up of the S&P 500 index, how much of the index's return those handful of companies have generated. And recently, the percentage of US GDP, we're reaching very, very high levels of GDP as it relates to the Mag 7 names and their concentration. What I want to focus on today, though, is how the business models for these companies are changing as they build out the infrastructure for their AI platforms, the AI revolution, so to speak. Historically, these companies have been very asset light, ultra scalable software, cloud computing companies, but recently they have started to go on a spending spree, as the charts indicate. And a lot of this is for the build out of the infrastructure that is needed to develop AI and to run AI. The shift here has turned them actually into pretty asset heavy, capital intensive businesses, meaning they're spending a lot of money in order to keep running. And that changes the business model, specifically in that it means that a lot of their success hinges on the spending decisions, meaning how they deploy the capital that they're taking on. So you can see the chart on the left there. CapEx has gone up significantly, and this is just for Amazon, Microsoft, and and Google. And then on the right there, this is the big tech companies' bond issuance. So it points to how they're starting to finance the AI build out. On the front end of it, they were by and large able to cash flow a lot of this build out themselves. But as the price for data centers, the infrastructure needed has ballooned, we're talking $25-30 billion projects, they've had to tap other areas of the financial markets in order to provide that capital. Debt that they've raised here is then sold off to other investors inside of traditional bond funds, as well as in private equity and private credit. And so that risk is starting to be spread out a little bit more into other areas of the market. All of the capital investment into AI really begs the question of whether or not the investments will be able to provide the return that justifies all of the spending that we're seeing from them. As of right now, Morgan Stanley is projecting that the big tech companies will spend nearly $3 trillion from now until 2028, and the cash that they'll generate will be about half of that. So we definitely need to see some advancement here for the cash to be able to cover the cost of the capital that they're using in order to build all of this stuff out. The take-home point here is really that it's very possible that all of this investment pays off and that things go well, but it is increasingly important for us as asset managers and allocators to be aware of how these companies are changing as they're taking on these new initiatives and where the risks are. We want to make sure that we are still compensated for the risk adequately when we decide to take risk on. And so as this AI revolution continues to unfold, as these companies continue to change their approach to how they navigate this build out, we'll continue to be tapped in on where the risk is and making sure that we're compensated accordingly.
All right. Thank you so much, Zach. That's this week's Market Carver. We hope you join us again next week. As always, if you have any questions, please give us a call on your number on your screen or our website, also shown below. Thank you so much and have a great weekend.